Volume, Quantitative Methods, Learning Module, Rates and Returns. Topic, Money-Weighted and Time-Weighted Return. Designation, CFA Level 1. The investor puts money into a private equity fund at different times. It shows the average annual return considering the timing of cash flows. Cash flows in year 0, negative 500,000. Cash flow in year 1, 0. Cash flows in year 2, negative 200,000. Cash flows in year 3, plus 900,000. Money-weighted return is the same as the internal rate of return. Using financial calculator, the internal rate of return, IRR, equals 10.7%. When you see cash flows spread across years, always think money-weighted return, or IRR. Master how to use IRR function from financial calculator. This is the same question as the previous one, but with different wordings. Also, this illustration differentiates how we view the problem, whether from investor's view or from investment's view. From investor's view, cash flow of the investment equals cash inflow minus cash outflow. At year 0, making an investment is cash outflow from investor's view. Cash inflow minus cash outflow is negative 500. At year 1, from investor's view, received dividend is cash inflow. Making another investment is cash outflow. So cash inflow minus cash outflow is 0, and so on. The fund gets investments at different times, 2,000, 6,000, and 50,000. Returns are different each year, plus 12%, plus 10%, and negative 6%. Time-weighted return looks only at the returns each year, ignoring how much money was invested. Geometric mean return averages the returns over time, also ignoring the size of investments. Money-weighted return considers both the returns and the actual cash flows, how much was invested each year. Because the investment amounts are very different, small at first, huge in year 3, the money-weighted return will be different from the time-weighted and geometric mean returns. If cash flows are uneven, money-weighted return does not equal time-weighted return. Time-weighted and geometric mean focus only on performance, not on cash flow size. The large investment in year 3, 50,000, with a negative return, minus 6%, pulls the money-weighted return down compared to the others. The return measure that is different is the money-weighted rate of return, because it depends on the timing and size of investments. A fund earns returns in 2 years, plus 11% in year 1 and plus 21% in year 2. But in year 2, there is a huge new contribution, 90 million US dollars, compared to the original 25 million US dollars. Time-weighted return looks only at the returns each year, ignoring how much money was invested. Year 1 return plus 11%, Year 2 return plus 21%. Time-weighted return equals 15.8%. Money-weighted return considers both returns and the actual cash flows. Because a huge amount, 90 million, was invested before year 2, the negative or positive return in year 2 dominates the calculation. Since year 2 had a strong positive 21% return, the money-weighted return will be greater than the time-weighted return. If a large cash flow happens before a strong positive return, money-weighted return is greater than time-weighted return. If a large cash flow happens before a weak or negative return, money-weighted return is lesser than time-weighted return. Here, the big contribution before positive 21% makes money-weighted return higher. Money-weighted return changes when investors add or withdraw money at different times. Adding money before a bad year makes money-weighted return lower. Withdrawing money before a bad year makes money-weighted return higher. Money-weighted return reflects the investor's actual experience, not just the fund's return path. Timing of cash flows matters. Cash flow in the investment equals cash inflow minus cash outflow. From investors' view, cash inflow at year 0 is none. Cash outflow at year 0 is 90. So cash flow at year 0, or CF0 in financial calculator, is 0 minus 90 equals minus 90. Cash inflow at year 1 is 2.5, the dividend. Cash outflow at year 1 is none. So cash flow at year 1, or CF1, is 2.5 minus 0 equals 2.5. Year 2 is the same. At year 3, when the investment is sold, cash inflow at year 3 is 105, the sale, and 3 for dividend. Cash outflow at year 3 is none. So cash flow at year 3, or CF3, is 105 plus 3 minus 0 equals 108. Using financial calculator, IRR equals 8.17%. Using this cash flow in the investment equals cash inflow minus cash outflow formula prevents confusion which one is inflow, which one is outflow, which period it occurs. Single period time-weighted return is the same as holding period return. Multi-period time-weighted return is the same as geometric mean return, compounding. On money-weighted return, remember to use cash flow of the investment formula equals cash inflow minus cash outflow. Master it on financial calculator. Time-weighted return over 4 quarters, 1 year, is the annualized time-weighted return for the year. You don't need to compound the rate. This topic is about annualized return from learning module, rates and returns. Here, the same formula but a bit different in wordings. The formula to make returns annually, annualized return equals 1 plus R to the period needed divided by period stated power minus 1. The period needed is how many periods in annual. Period stated is periods given on the question. If the period stated is in days, period needed to annualize is 365. If the period stated is in weeks, period needed to annualize is 52, and so on. Always remember to annualize. The period needed is the denominator. Continuously compounded return uses the natural log of the price ratio. It will be slightly more negative than the simple percentage change. Simple return equals 132 minus 150 divided by 150 equals negative 12.0%. Log return equals negative 12.78%, a bit lower. Simple return formula equals ending price minus beginning price divided by beginning price for basic percentage change. Log return formula equals natural log of ending price divided by beginning price for continuously compounded return. This distinction is important because log returns add up neatly across multiple periods, while simple returns do not. We want the present value of $8,000 received in 5 years. The discount rate is 6% compounded monthly. The formula for non-annual compounded return is this one. The period can be daily, weekly, monthly, quarterly, or semi-annually. Monthly compounding reduces PV compared to annual compounding because money grows faster with more frequent compounding. So you need to invest less today to reach the same future value. This is compounded weekly example. The period needed is 52 weeks. The period stated is 8 weeks. This is the formula for future value compounded continuously. Continuous compounding uses exponential to the r times t power instead of 1 plus r to the t power. The future value is slightly higher than with annual compounding. Another example of continuously compounded rate of return. Using this formula, have to convert every period t into a year. If the period is 25 days, convert it into a year equals 25 is divided by 365 equals 0.068. And the power is 1 divided by 0.068. This is how to find holding period return when annualized return is given. Use the same formula as annualized return formula. More frequent compounding, such as quarterly versus annually, gives a slightly higher future value. That's because interest is added more often, so it grows faster. Therefore, future value with quarterly compounding is greater than future value with annual compounding. This topic is about other major return measures and their applications from Learning Module, Rates and Returns. We need the leveraged return, the return to equity holders after debt cost. The simplest formula is using the dollar terms. Leveraged return equals portfolio return minus debt cost divided by equity. When there is no money amount, such as here 40 million, just strip off the money amount to use in weighted terms. Leverage increases gains when investment return is higher than borrowing cost, and increases losses when investment return is lower than borrowing cost. Gross return equals return before deducting expenses such as management fees, trading costs, or taxes. It shows the total performance of the investments themselves, not what the investor actually takes home after costs. Net return equals gross return minus management fees, administrative costs. Gross return includes trading costs. Net return deducts all expenses. Leverage means borrowing money to invest more than your own equity. Borrowed funds must be repaid with interest. The effect depends on whether the portfolio's return is greater or less than the borrowing cost. If portfolio return is greater than borrowing cost, leverage increases equity returns. If portfolio return is less than borrowing cost, leverage reduces equity returns. Leverage is beneficial only if the investment earns more than the interest cost. Otherwise, it magnifies losses and reduces returns. Gross return already includes trading costs, so only subtract management or admin fees to get net return. It reflects investment skill after direct trading costs. Net return is what the fund delivers to investors after management fees. Leveraged return is investors' return after borrowing costs. It is pre-tax. After-tax return is investors' final take-home return after taxes. Each layer deducts additional costs, such as fees, interest, taxes. Leverage boosts returns if fund return is greater than borrowing cost. Taxes are applied last, after leverage. Gross return includes trading costs, but not operational expenses. ROI is after operational expenses. To get from investors' after-tax return back to firm's gross return, you must undo tax, undo leverage, add back operational expenses. Step 1. Work backwards from investors' after-tax return. Pre-tax leveraged return equals 10.625%. Step 2. Remove leverage effect. Firm's ROI equals 8.9375%. Step 3. Add operational expenses back to get gross return 10.1875%.